Ready for the fight? Okay, this is going to be very gory. Okay, so anyway, welcome friends once again. And this is a debate about active versus passive. Samir is a very passionate advocate of passive. Pramod is a passive advocate for active. Okay, so I'll start with you, Pramod, first. And why is your side, the active side, the stronger long-term proposition for Indian investors?
Well, thank you. Thanks for having me here. It's always a pleasure, and trust Cafemutual to come up with very interesting themes. And it's a great juncture to be discussing passives here. You talked about the big fight. I think I've come to what looks like a gunfight with a knife in my hand. So I'm starting with a losing battle, but I'll try my best to hold my ground. But before I begin, I like to sort of frame the question right? The definition of passive itself should be understood clearly. More often than not, we refer to passives as an index fund, which is tracking an index which is predominantly market cap weighted, right? In some ways, the market cap weighting of the index itself makes it active. So it's not necessarily active. So let's agree to define active is where a human being is making discretionary judgment about stock selection and market timing. Everything else is passive, or what I'd like to call it as systematic or rules-based. So to that extent, I think passives have been one of the best innovation. I'm not throwing in the towel straight up front, but I'll come to the complication. Passives, I think we're all big fans of Jack Bogle, who founded Vanguard. I think it's the biggest contribution in terms of financial innovation through low-cost investing in diversified benchmarks. I think you can think of other people maybe on the fingers of your hand in terms of having had an impact on global investing other than Jack Bogle. Having said that, that doesn't mean active is dead, right? If the argument is that most active managers fail to perform or beat the benchmark, we can make the argument for most startups which fail. Most restaurants actually don't make money and fail. Most movies fail. Yet, startup is a thriving enterprise. We all go to restaurants. We all go to movies. The distinction is, do not paint all of them with the same brush, right? There are good restaurants, there are bad restaurants, there are good movies, there are bad movies. Similarly, there are good active managers and not so good ones. And we need to focus on the handful of active managers who actually outperform. And I think this country itself has been blessed with a bunch of legendary active managers who've beaten the benchmarks over long periods of time. Having said that, even those handful of active managers go through their own performance cycles. I think all of you would be familiar, perhaps, with two of the greatest CIOs the country's had themselves have been through long periods of underperformance. Now, what this creates as a challenge in active management is the typical performance-chasing behavior of investors and distributors. Because even a good manager's short-term performance can be cyclical, we end up getting into funds right at the peak of the performance and getting out of funds at the peak of or the bottom of their performance. So it is more of a behavioral challenge that's facing active investment as opposed to generally all active managers being bad. I'll delve deeper later on in the debate, but the world I foresee is a world where both passives and actives coexist very well. And that's where hopefully the debate will bring the nuance.
So, Samir, why is passive the stronger proposition for long-term investors?
So thanks, Prem, for having me on this exciting debate. Let me start by mentioning an irony. A lot of famous active managers in the US, when they are in their twilight years or writing their memoirs, become strong advocates of index funds. Okay. And let me name a few, because they are US names, so I can take them. Peter Lynch, Bill Miller, Bill Gross, Henry Blodgett, and the patron saint of active managers globally, Warren Buffett and Charlie Munger. Warren Buffett, since 1993, in most of his annual reports, has strongly advocated index investing for majority of the investors. In fact, as you might be aware, his estate has been willed to the Vanguard S&P 500 index fund. And believe me, nobody knows the value of passive more than somebody who has been in the blast furnace of active management. Okay. So that is the irony I want to start with. And I can tell you anecdotally, in my more than 3 decades of experience on the sell side and the buy side, there are many active managers in India who in private advocate passive. And there are many intermediaries who invest their own money in passive. Okay. So this is what I want to leave on the table as my opening remarks.
Okay, great. So we've got off to a rocking start. So one of the things, Pramod, there are 2 problems with active fund managers. I don't know who's going to perform in the future. I don't know. So these are guys we discover 15 years later, 20 years later, only to find sometimes that at the peak they tend to also ebb. So how do I, first of all, find out who is going to outperform in future? We don't know. Leave alone fund managers, we can't talk about even specific funds. The other thing is, there's a lot of evidence. There is something called a SPIVA report, with which you would be very familiar, which suggests that outperformance, particularly in large cap categories, is becoming a challenge. So I don't know who's going to perform. And in any case, most of them are not able to perform. So why should I pay them for active management? Why should I pay extra?
No, fair enough. I think the SPIVA data is now ubiquitous. All of us have been through that. In the US, it's extreme. 90% of active fund managers fail to outperform the index. Now, this is not an anomaly. It's almost by design, right? By definition, 50% of active managers will beat the benchmark and 50% will underperform the benchmark, right? Because it's a zero-sum game. Now, add fees to it and other expenses, more than 50% will underperform. So the fact that most active fund managers fail to beat the benchmark is a given. It's almost by design. It's not even an anomaly. The anomaly is, why are 90% of them failing to beat the benchmark? Now, part of it is the doing of our own industry. If you see a whole host of active funds, they're not really active funds. There's a term called closet indexers. Most of them are literally hugging the benchmark with a little bit of overweight position on this, a little bit of underweight position on this. So that cohort of active fund management needs to be disrupted. The growth of passives is doing a good job, where you are disrupting fund managers who are not really taking differentiated calls from the benchmark, and for hugging the benchmark, they're charging fees. Having said that, your question about how do you choose fund managers without knowing who's going to outperform in the future is very, very relevant, because it is really hard. Like I said, even the best performing fund managers have cyclical underperformance. It is a given. Nobody outperforms every single year. Therefore, the most you can do as advisors when it comes to fund selection is focus on the philosophy of the fund manager, whether the fund manager is bringing something truly differentiated to the market, and more importantly, focus on the process adherence of the fund manager. Is the fund manager trying to stick to the stated philosophy? Because otherwise, the basis on which you made the investment itself could change, and you are running around in circles. More importantly, I think active management is becoming more of a behavioral skill than any great insight or information. Back in the day, there was genuinely information alpha, right? Where few fund managers had access to Bloomberg terminals. Today, with Screener, a retail investor can get access to fundamental data. So information advantage went away in the post-internet world. Then there was the insight advantage. It's not just about information. How do you piece together different types of information using mosaic theory to come out with insights which the market as a whole is not doing? Even that has been disrupted. Look at the number of blogs which are on single stocks. Look at the number of podcasts. There's a podcast called Business Breakdowns. It's phenomenal. You can get professional fund manager level of insight using that. Well, what none of these blogs or information can provide is the behavioral part, which is the end of the day, active fund management depends on two personality traits. One is patience, because you will inevitably underperform. Do you have the patience to hold true to your stated philosophy in the process? And the second is humility, because all of us are human beings and we can go wrong with calls. It's by given. When you do go wrong, do you have the humility to acknowledge and course correct? This, I can't tell you, is perhaps the rarest of rare skills. Right? Most of us would want to believe. Patience, for example, many of you would be familiar with your own behavior, your clients' behavior. It's not easy. And therefore, 90% underperforming now suddenly doesn't become an anomaly, because it's such a rare skill. Only a handful will outperform. So I'll end with an anecdote which an institutional pension fund manager gave me, how he goes about selecting managers. He says, I spend most of my time evaluating the manager as a person on these traits, on the process adherence, on being true to the philosophy. I almost never look at his performance track record. But once I've been convinced that the fund manager has something truly different to bring to the table and has these traits of patience and humility to stick to that, I almost always invest when he's going through a period of underperformance, because the cyclicality is given. So that can be a tool where you guys can add value by spending more time in assessing the fund manager on these traits, the philosophy and the process adherence, rather than looking at past track records.
Okay. So, Samir, why should investors settle for benchmark returns in a rapidly growing economy like India, which offers so many opportunities? In fact, earlier in the day, in one of the panel discussions, Vishal Kapoor of Bandhan was telling us, and I liked that argument, that over a period of time, the number of opportunities which can make money is growing in India, even in listed markets. So he was telling us how earlier the focus was on just the top 100, 150 stocks. Now that basket of securities has expanded and it has moved, and now even going down the order, you find that the companies are big and solid, following good governance standard. तो हमारे यहाँ तो discover होते जा रहा है. So why should I settle for benchmark returns?
So Prem, very good question. See, what should be the true benchmark for equity investing? Inflation, according to me.
Okay.
Equity investment is not a championship of the highest returns.
It's not a
championship of the highest returns. Okay. So let me take the most simple no-brainer portfolio, the Nifty Total Market Index. Okay, which is 95% of your MCAP. इसमें कुछ नहीं करना है.
Okay.
सिर्फ पूरा इंडेक्स लेके बैठ जाना है. That's done about 14% CAGR over the past decade or so. Now, what more do you want? Okay. The only return going forward that I can be sure of is the broad market index return, which I can capture. Okay. All these stories about के past पे ये था, when my grandfather invested, if I had put in so much of money in so and so fund, it would have multiplied to so much and so amount, is I think all, I wouldn't subscribe to that, because I have to look in the future, and the only return that I can hope to capture, whatever it is the broad market index return. Everything else will go either ways. So if broad market index return is at the silver medal, the gold medal, the outperformers, and the bronze medal, the underperformers, will keep changing all the time. And I'll know only in hindsight, unless I am gifted with a crystal ball. So I should be beating inflation, keep my risks down, eliminate the non-systemic risks, which is the fund manager risk and the stock-specific risk, and have the core part of the portfolio in a broad benchmark. Okay. So very simple analogy I want to use for the broad market index.
Yeah.
From the Mahabharata. In the Mahabharata, there is the Virat Swarup Darshan. So total market index is your Virat Swarup. Individual stocks and managers are Nashwar. Okay, Nashwar, when I say, I'm not saying they'll die. I'm saying the alpha is Nashwar. So by the Virat Swarup of the market, okay, nothing is as simple as that. तो महाभारत का एग्जाम्पल दिया है, तो लेट मी टेक वन फ्रॉम द रामायण ऑल्सो. तो रामायण में Hanumanji Laksh is sent for stock picking, Sanjeevani booty. So he, instead of doing that, he carries the entire total market index. So we are all religious people. तो जो उन्होंने किया वही हमको करना है. As simple as that.
Okay. Now, one question to both of you. If active funds also become like commodities, you say many of them are closet indexers, the index hugging funds, then does the advisor become more important in active funds? The same question to you. If passive funds become commodities, because essentially in some sense they are, what is the role of the advisor? Does it become more important or does it become less important? I'll start with you, Pramod.
Yeah, before coming to the advisor's role, which I don't think will change, whether it's a passives world or actives world or a combination of that. One of the things I want to highlight is about the broad market definition. There was a time when an S&P 500 was considered to be a broad market, right? Which was the original definition of Jack Bogle. Buy the haystack, not the needle in the haystack. The haystack was the Sanjeevani, which was on the Govardhan mountain, right? But today, if you look at the S&P 500, like I said, it is following a market cap weighted index, right? So a market cap weighted index by definition allocates more to a stock which has gone up in price, right? And reduces the weight of the stock which has gone down in price. An index fund which is tracking this, what does it do? It'll have to buy the stock whose weight has gone up. It'll have to sell the stock whose weight has come down. What are you doing here? You're doing exactly the opposite of Holy Grail of investing. Holy Grail of investing is buy low and sell high. If you are an index fund tracking a market cap weighted index, you're going to do the opposite. Now we're seeing the repercussions of that in the US, right? Given the AI rally, the tech rally, we can all agree to disagree that none of us have a view whether this is a bubble or not. Or what this has done is, what was supposed to be a broad market has become a very, very concentrated market. I'll give you 3 numbers. The top 10 stocks in the S&P 500 contribute to 40% of the index today, right? You're buying 500 stocks, but 10 stocks drive 40%. In Korea, 2 stocks, Samsung and SK Hynix, make up 40% in the index today. Worse, in Taiwan, TSMC, 1 stock alone makes 40% of the index. While you are investing in a broad market index fund, you think I'm very well diversified, but actually you're betting on one single theme. And we know what's going to happen should the AI bubble burst. I have no idea whether it will burst or not. And it's not like you are safe, diversified, but that's the challenge with the market cap weighted index. There are a whole host of other passives which index to fundamentals which can address this problem. But just to address Prem's question on the advisor's role, I think the advisor's role is something that Harshji embodies, and he already illustrated. The first role is about goal-based planning and asset allocation. That will always remain, whether you put 100% in passives, 100% actives, or a mix of both. The second is manager selection, for which I laid down evaluation of philosophy and process adherence. But the third is the biggest role, which is behavioral counseling. Like I said, whether it's passives, if the if the AI rally bursts, there will be mayhem, right? Your S&P 500 allocation can go down 30-40%. At that time, it doesn't matter. Your client is bound to panic. And that's where your biggest role is as a counselor, to ensure that they don't do the stupid thing at the bottom of the market. At the same time, don't chase these bubbles. That cannot be replaced by any AI or technology. So in my view, the advisor role will be there 10 years, 20 years, 30 years down the line. We'll all rely on human beings who we trust to provide that counsel.
So, Samir, question to you. Yeah. If passive funds are more like commodities, what is the role of the distributor or the advisor?
Very important role. I think a lot of what Harshji said is very important. Apart from asset allocation and all those things that he mentioned, I think it's the behavioral role which is very, very critical. Okay. The advisor is almost a steward to investor assets. Okay. So he's like a true friend. Okay. A genuine advisor. So I think that behavioral role nobody can replace, no AI, nothing can replace. And that is where, the advisor's role, I think, is critical. But if I can just have a rejoinder to what he said about cap-weighted indexing. Okay, because I have to say it. I think cap-weighted indexing, if I may quote Ben Carlson, okay, one of the famous, writers in the US, financial authors, it's a strategy where you automatically gravitate towards the winners because they are at the top of the cap-weighted index. And it's a reflection of the collective wisdom of the market. Okay. Value, according to me, is very subjective. ये overvalued है, undervalued है. Value lies in the eyes of the behold. Okay. So value is very subjective. So automatically, because you're riding the collective wisdom, you automatically gravitate towards the winners. Okay. If they are few, fine. Okay. It's okay. And as data tells us, most of the fund managers underperform the broad marketplaces. Okay. Great.
Just a quick rebuttal. It's gravitating towards the winners after the winner is already won. You're buying after it's gone up. I think I just wanted to make that point.
Okay, time is up. There is just one last question. There's a whole bunch of distributors here. What would you sincerely advise them? Imagine that they are your favorite nephews here and nieces in the audience here. What would you advise them? Would you advise them to allocate 100% of their clients' money? Should 100% of the portfolio be made up of passive? If not, what should be the proportion?
See, I think one should do a core and satellite allocation where the core should be passive and the satellite component can be any component of active. Because if the core is stable, in the core you have to capture the market rate of return. See, fast train pakadne mein aap slow train bhi chook jayenge, so that will create a lot of issues. And it actually, is damaging to the clients. And as far as the payouts are concerned, as far as index funds are concerned, I'm talking about index funds, I think with the, reducing scale on the active side, more the AUM, lower is the, payout. Passive payouts match active payouts in many of the index funds. So I think commercially also, index funds are extremely viable. So it is very important for advisors to have core component of the client's portfolio in passive.
So,
I agree with Samir. We end on an agreeable note. I think the core allocation to passives makes sense. Like somebody said, in pursuit of alpha, you forget beta. Let's get the beta first. Because 70% core is a reasonable number, allocate to passives. And the 30% to actives is important because remember, asset allocation works only if you allocate to assets which are uncorrelated, right? Active managers, not the closet indexers, genuinely active managers with high active shares which have very limited overlap with the benchmark are giving you that low correlation advantage, are giving you the benefits of diversification, particularly at a time like this in the US where risks of AI bust is pretty high. If you can find a manager who is allocating to stocks which haven't participated in this rally, which is completely devoid of the benchmark, you will ensure that the drawdown that the client will experience eventually when the bust happens, if the bust happens, will be limited. And that will also give you huge opportunities to systematically rebalance.
Okay. So on that note, we end the debate. The debate has been a resounding success. Okay. And I'm glad, Pramod, we are at a passives conference and I'm glad that you have the maturity to say that, yes, there is a place for passives. That shows a lot of generosity and maturity on your part. Samir, as always, very passionate advocate of passives. And thank you for coming here and putting your views. Let's have a big round of applause for these two gentlemen.